Welcome back to part 2. Now that you know stocks, bonds, and Forex, let's unlock the high audit world of digital assets, leverage, and how big money rotates between them all. Let's demystify crypto first. Cryptocurrencies like Bitcoin are digital, decentralized assets. They operate on public ledger blockchains, completely free from central bank control. Why do people trade crypto? Because of absolute scarcity. While central banks can print unlimited dollars or rubies, Bitcoin has a hard-coded limit of exactly 21 million coins. Then there's Ethereum. Think of Ethereum not just as blockchain's money, but as a giant global software platform that lets developers build decentralized financial applications using smart contracts. But hear this, crypto is incredibly volatile. Driven by global liquidity and retail sentiment, assets can swing 20% in days. It is high reward, but extremely high risk. That volatility brings us directly to our fifth asset class, the ultimate double-edged sword. Derivatives, specifically futures and options, or F&O. A derivative is a financial contract that derives its value from an underlying asset, like a stock, index, or commodity. You aren't buying the asset itself, just a contract on its future price. The core superpower of F&O is leverage. You can control a massive position of shares with just a small fraction of the capital up front. This amplifies both your profits and your losses. A futures contract obligates you to buy or sell an asset at a predetermined price on a specific future date. It's used heavily by institutions to hedge risk or speculate. A futures contract obligates you to buy or sell an asset at a predetermined price on a specific future date. It's used heavily by institutions to hedge risk or speculate. An option is different. It gives you the right, but not the obligation, to buy or sell. Call options are bets that the price will go up, while put options are bets it will fall. An option is different. It gives you the right, but not the obligation, to buy or sell. Call options are bets that the price will go up, while put options are bets it will fall. Now, why must you understand all 5 asset categories? Because of capital rotation. Wall Street institutions don't keep cash sitting still. They constantly rotate it to maximize yield. When the stock market is crashing and fear is high, big money exits stocks. They buy safe, interest-bearing government bonds, causing bond prices to rise. When the economy is booming and interest rates are low, institutions sell low-yield bonds. They pour capital back into stocks and high-growth crypto to seek higher returns. In geopolitical crises, global funds run to Forex, buying safe haven US dollars or solid currencies. Understanding this giant capital loop is how you learn to read the entire global macro trend. In our next video, we are moving to passive investing. We'll show you index funds, ETFs, and dollar-cost average trading to build long-term wealth. This is your journey to financial mastery, one step at a time. Subscribe, turn on notifications, and drop a comment below on which asset you want to learn about next. See you in the next lesson.